series. Today we have a special guest, 4 guests in fact, from the Brenner Group, which is a valuation firm here in Silicon Valley. And today's webinar topic is going to be demystifying valuations for venture-backed companies. During the next 45 minutes or so, we'll have a discussion of valuation methodologies used for tax and accounting purposes. So with that, our speakers today are John Heath, Executive Vice President, Gunther Hofmann, Vice President, Brooke Bailey, Vice President, and Diane Escobar, Director of Client Relationships at the Brenner Group. So I think I'll let you take it away.
Well, thank you. As Roger indicated, my name is Diane Escobar, and Director of Client Relations at the firm. I am fairly new to the firm, but actually have been well taught by Mr. Heath himself. So thank you all very much. Quickly, a few introductions. John Heath, Executive Vice President with the group. Brooke Bailey, one of our wonderful valuation specialists, and Gunther Hofmann, Vice President Valuation Specialist. We're going to do a quick overview. We're also going to talk about some regulation and compliance issues in regards to valuation and methods and approaches that we use to get those valuations. A little bit about the Brenner Group. Our core business is valuations and financial advisory. We have restructuring services and interim management. What that means is we have CFOs for rent, if you were per se. Our professionals average about 25 years of experience within the firm. We have in excess of 1,500 clients in a wide spectrum of industries, including technology, especially here in the Silicon Valley. We've been in business for 26 years, and we'll go over why that actually in itself is important. This is a few of our valuation members, our group here. We have John Heath, Gunther, we have a gentleman, Paul Cross, but all of these are very well certified valuation, either analysts or financial analysts who are working within the firm. And of course, we have several other people within the firm as well on our team. A little bit about the team's experience. Again, as John indicated, we do have some gifts in the state, but we primarily focus on IRC 409A, and as well as Accounting Code 718. We'll go over more detail if anyone has any questions on those. But we do gifts in the state. We offer fairness opinions, transactions, portfolio evaluations in regards to accounting 820, purchase price allocations. We are often retained for litigation support in regards to evaluations, and are actually in the middle of an expert litigation services right now. We do purchaser representative, as well as investment banking and M&A. Some of our achievements as a firm, we've actually closed over $3 billion of public and private debt and equity financing. We have over 80 strategic alliances. And very proud to say we've actually evaluated over 1,200 valuation opinions and delivered. Okay, so quick, let me bring up John Heath, Vice President for Brenner Group.
Thanks, Diane. So I'm going to spend a few minutes talking about regulation compliance issues as it relates to tax and financial reporting. Brooke is then going to talk about kind of how the methodologies and approaches are used to value the company as an entity. And then Gunther is going to get up and discuss with you how the entity valuation gets allocated across different classes of securities, again, for financial and tax reporting purposes. So principally from a tax standpoint in our practice, it's IRC 409A, or it's estate and gift. It is fair market value, standard of value, unlike financial reporting, which is fair value. And we'll get into some differences between fair value and fair market value. They can be material in certain circumstances. Most of our financial reporting work is 718, which some people may know otherwise as 123R. The old 123R is basically the requirement that companies who are issuing GAAP financials expense share-based payments on those statements. Also ASC 805 and 360, which relate to purchase price allocation and impairment. That's for companies who are acquiring other companies and have to allocate those values for tax and financial reporting. So the big driver of valuation services in the Valley is Section 409A, which was essentially adopted in 2004, got published in third quarter of 2005, and essentially requires that all companies, private or public, basically set the exercise price of their options at no less than fair market value. And how you get the fair market value, we'll talk about that in a minute. So it not only relates to options, but it also relates to stock appreciation rights that companies may be granting. The code section requires that, or provides guidance that valuation is good for no more than 12 months from the date of value. You want to wait, or should I?
Go
okay. At least annually. Frequently, though, companies have intervening events between, say, let's say they're doing December 31/12 and December 31/13. Frequently, there are intervening events like capital raises, new CEOs, major new customers, which give rise to a change in the forecast, which may give rise to a change in the valuation, and therefore interim valuations are required to support any interim grants. We also saw a lot of clients that came in after Lehman Brothers went down in 2008 in order to set the price down on their options. Again, remembering that most Valley companies use options as a management incentive for their employees. So we talked about kind of what the requirement is. It would be no less than fair market value. There are 3 safe harbor avenues provided for in the code. One is an independent appraisal by a qualified independent appraiser. Again, no more than 12 months, and also no intervening events that would give rise to an upward valuation. Obviously, those are all our clients. They're coming to us because they want independent valuation. The board generally will look at that as sort of a cheap insurance policy and protection from recourse, and we'll talk about what that recourse may be. The second option available under the safe harbor is if the company's got a formula that it uses for all its share-based transactions. So, let's, for sake of argument, say it's 1 times revenue discounted at 70% for liquidity and other issues. Assuming that they can demonstrate that they've used that formula, that presumptively is a valid safe harbor. The third avenue that the code calls out is an independent or an internal individual who may have some expertise in valuation, whether that's a director, maybe a CFO, somebody who, in theory, others would rely on for valuation, in which case they could do their own internal valuation, and presumably the board could rely on that as a defense. Obviously, we don't see any of those folks because they're doing it internally. Although when this all started back in 2005, 2006, we got a lot of people who were sort of inquiring on both paths, and I suspect these days there aren't a lot of folks that are doing this just because of the exposure. So the presumption is, as long as the assumptions and methodologies are not grossly unreasonable, then it should be allowable and usable as a defense. We actually have the first case that is being prosecuted by the IRS, and we'll talk about that in a minute. But again, from a tax standpoint, the code calls that, and court cases and other precedent call out certain things that we all must sort of look at and review in the process of putting together an evaluation. We'll talk more about this as we get into the presentation. So why does everybody care about 409A? They care about it because there's a 20% additional tax if you're out of compliance with 409A. And that's only half the problem. The other half is that California state income tax also imposes a 20% penalty. So you've got a total of 40% penalties plus interest from the date of exercise. So anyway, we'll get into an example here because that'll I'm sorry, from data vesting, not data exercise. So in the assumption, we assume that the grant was at $5 for however it was determined. The IRS concluded that fair market value at that grant date was $7, therefore it qualifies for 409A, or subject to 409A penalties. We presume here that the exit or fair market value at date of determination is $10, and that there's 500,000 shares subject to this particular option that are being exercised. So there's $2.5 million gain, which is taxable. We have a new, thanks to recent legislation, we have a new tax rate, max tax rate. Presumption here is that this is a wealthy individual, and at the margin he's paying almost 40%, or she's paying 40% tax. Federal, another 12 plus 3% at the state. And then here's where 409A comes in. You have another $1 million of penalties and a whole bunch of unknowns in terms of interest payments, again, from the date of vesting until the date of determination, together with lawyers' fees, accountants' fees, tax fees, whatever. So the bottom line is, under this, and this is sort of a best case assumption, is that the individual's coming out with less than 8% of the gain, approximately 8% of the gain, but we know that that's not right because there's going to be a whole lot of other charges in here just to get to a point of resolution on this. I mentioned a little earlier that there was a case. It's in front of the Federal Court of Claims. It involves the CEO of Marvell Semiconductor right down here in the Valley. He was given a grant back in 2004. He exercised it in 2006. So we're now in 2013, and it's finally getting prosecuted. The interesting thing is sort of the underlying issue in the case is essentially backdating. But because the service determined that at the date the board ratified the option, the stock was $7, more or less $7.50 higher than the date that the grant was made. And I can't tell you the differences between those two because I don't have enough details on the case, but that's essentially the IRS's position. They've just had a hearing where the trial judge has just reviewed a series of motions brought by the taxpayer, in which the judge found for the IRS on all four cases, all four motions. So it's going to trial. There's in excess, I've forgotten, I think it's about $5.3 million that's actually being contested here. So it's real money. To our knowledge, this is the first case, a material case that the IRS has brought under 409A for stock options. This is, can't quite see it up here, but this is just a quick discussion of 718. Again, this is financial reporting. This will be for your clients who are actually issuing GAAP-based financial statements. Essentially requires that, as I mentioned earlier, all share-based payments be expensed on the financial statement. And the standard is fair value, unlike tax, which is fair market value. These are some of the inputs that go into the calculation of 718. The base almost always is the value established for 409A. So the reality is most of the valuation work we're doing that's done for 409A is also being done for 718. That's not unique to us. That's true of everyone in the valuation business. The standards and guidance is provided through something called Valuation of Privately Held Equity Securities, issued by the AICPA, again, back in the 2004, originally back in 2004. It's since been updated and is currently in a revised draft now. This should be of some interest. This basically spells out the differences in premise of a standard of value for tax under IRC 409A and financial reporting. There are a couple of key differences. One is hierarchy of inputs. In the case of tax, it is generally left to the discretion and judgment of the evaluator in terms of what input, what factors to consider. Whereas for financial reporting, they spell out 3 different levels and in ranked priority that have to be considered. So, you know, a case in point is that for financial reporting, if there's a recent transaction in, let's say, another common stock of an existing corporation and third-party transaction, financial reporting would require essentially that be given the greatest weight because it is most directly comparable. Even though in the judgment of the evaluator, it may not be comparable because of a range of different issues, whether it's not arm's length, whether it's small transaction, one-off. There are a host of reasons why it might not be relevant. The other big difference is basically the use assumption. For tax purposes, it's essentially an evaluation of the individuals that are party to that transaction or contemplated transaction. So it's a very sort of specific use intention as opposed to financial reporting, which is market participant. And that requires the use for the highest and best use for any participant in the market. As a result of those, the outcomes for financial reporting generally have a higher bias in outcome than you would for tax reporting. So again, we're sort of in a position where we're trying to manage that within the context of a client who wants, you know, relatively low values as an outcome for their 409A, and the auditors who want relatively high values for their 718 work. So at this point, I'd like to turn over to Brooke. And as I say, Brooke is going to show you kind of how we set up the value for the entity.
Thanks, John. So we thought it would be helpful to talk a little bit about the process and what this looks like from our point of view when a project comes in. The first thing we obviously want to do is define the assignment. And for a 409A valuation, we're looking to value a single share of the company's common stock on a private, non-marketable basis. And as John mentioned, we'll be using fair market value as the standard valuation. Then we'll want to establish a qualitative foundation, understand how the economy is at the date of value, what the environment's like for venture-backed companies. Is there a lot of money chasing deals, or is it 2008 and no one can get $1? We want to understand the industry that the company is operating in and the company's background, especially management's experience and what they bring to the table. And then we'll take an analytical foundation. We'll do a financial analysis, industry ratio, trend analysis. We'll determine guideline companies and whether any normalizing adjustments will need to be made to the financials that the company provides. And then we'll want to establish a valuation foundation, which I'll talk about in more detail. Which approach will we be using to value the company, and then how will we allocate that value across the classes of stock. So here are the methods. Again, we've got 3 approaches to value the enterprise: income, asset, and market approach. Ideally, we'll be using more than one approach to corroborate the values that we come up with. Once we've established the value of the enterprise, we'll be allocating that value across the company's classes of stock, whether it's common, preferred, options, and warrants. And we've got 3 methods to allocate that value, which again may be stage dependent, sort of given where the company is. And we'll want to consider any discounts and premiums that might be relevant given the company's profile. So in valuation theory, it's important to remember there are various levels of value. So when we talk about the share price of Facebook or the market cap of Google, we're really talking about a publicly traded minority value. So it's based off of a single share price. For a financial or a corporate buyer, you would expect to see a sizable premium paid because they have control of the company, they can guide the company's direction, its financial structure, et cetera. And that can range from anywhere from 20 to 50%. Again, in 409A, we're taking a non-marketable minority value as the basis of value. So we would expect to take a discount from that publicly traded price, typically 10 to 50%, again, depending on the stage of the company and the attributes of the stock. Some of the key issues when we look at venture-backed companies, first of all, is understanding what's the company's stage. Is it a few guys in a garage? Is there an actual product that's been developed? Are they growing revenue, positive cash flow, or are they ready to go public? So anywhere along this continuum, it's important to understand for determining the discount rate, for determining which valuation method to use, and for the allocation method as well. Some of the things we face are complex capital structures, understanding all the terms of the preferred. As you can imagine, in later stage companies, when there are multiple rounds of preferreds with different rights and preferences, it can get fairly complex in modeling. Management carve-outs can be fairly complex. Appreciate the legal work, but sometimes it takes a lot of time to decipher and understand.
Does everybody know what a management carve-out is? Oh, yeah.
And we'll also want to understand the terms of any options or warrants that the company may have issued. Again, it's the three valuation approach: income, market, and asset. We'd be looking to do ideally more than one of those if we can. In the income approach, we're essentially discounting the company's projected cash flows or capitalizing them using a capitalization rate. Under the market approach, we'll be looking to publicly traded guideline companies, how they're being valued, any guideline M&A activity, how those are valued, any prior transactions in the company's security. We see a lot more second market shares posts as well as private funds that are going out and buying, particularly in later stage companies that have shown some traction. They're going out and approaching employees or ex-employees to purchase the common stock. So we need to understand in detail the nature of those transactions, and it's not always readily available. A lot of information gaps there. And lastly, the least sort of robust approach is an asset approach, again, analyzing the company's balance sheet on a replacement or reproduction cost basis. For a lot of early stage companies, the primary asset may be cash. There's typically not a lot of fixed assets. So again, not the best way to come up with a value. Discount cash flow analysis, excuse me. We'll be taking the company's projections and modeling out the future cash flows. We'll be picking a discount rate based on the stage of the company. For the period beyond that finite financial period, the remaining value is referred to as the terminal value, the value of all the future cash flows beyond that finite projection period. And for most companies, you'll see most of the value is actually the terminal value. Those interim years, there's not much cash flow, not much value being created, so a lot of it ends up being everything beyond that finite period. Some of the issues we've outlined below, again, those forecasts in general tend to be highly optimistic. We see repeat valuations where the company routinely misses what they said they would do a year or 6 months prior. We also assume a constant cost of capital across that period. So if the company really is making their numbers, you would expect that to be coming down. As far as determining those discount rates, there are a number of academic studies that we refer to, again, based on the stage of the company. There are ranges. The academic studies indicate ranges of expected returns by venture capitalists, which can serve as a check, sanity check to the discount rates that we ultimately use. The market approach, we're comparing the company, the subject company, to publicly traded companies. It can be the most challenging aspect of the project to determine who are the best guideline comps. Obviously, it's nice to have small, high-growth companies doing exactly what the company does, but in a lot of cases, that's really not achievable to find out in the public markets. We'll also consider guideline transactions to the extent that we can find relevant M&A transactions, and we can find valuation indications on those. We'll consider those as well. And as I mentioned, recent transactions. What was the pricing on the company's recent preferred rounds? Have they sold any common stock on private markets, et cetera? So in coming up with guideline companies, as I mentioned, we'll be looking at companies that are in similar lines of business to the extent that we can. We'll be calling information from databases such as CapIQ, looking to really hone in on companies that might be the most comparable. Typical valuation metrics that you'll see, we'll be looking at enterprise value in most cases, relating that to a financial metric of the subject companies, typically revenue. Since most of the companies we deal with don't have profitability yet, it's a little premature to be using profitability ratios. So an example metric would be enterprise value to forecast revenue. So we'll be looking at the public companies to see how they're being valued. And then we may be making any adjustments for, again, size, growth, and profitability characteristics of the guideline companies relative to the subject company. Under the asset approach, again, we're looking at the company's balance sheet, determining the replacement or reproduction costs of the company's assets. We can use it with very early stage companies when there's really nothing there, there's no financial forecast, or if a company has significant capital assets, which again we don't typically see here in the Valley too often. And it can serve as a reality check against the other approaches. So again, we'd like to use more than one approach as often as possible. So again, getting back to the stages of development and evaluation methods, as you'll see, asset approach at the very beginning, adding in income and market as the company matures. And we'll talk about allocation methods towards the end of the presentation. So we thought it would be good to show an example company. We've got a hypothetical company, New Design. It's in the electronic design automation software business, founded in 2010. It's stage 3, so it's got some revenue, but it's still operating at a loss. It has $15 million Series A, post-money value of $37.5 million, $1.50 a share. The preferred has 1x liquidation preference and full participation rights. And we'll be doing the valuation as of 12/31/2012. So here you can see the company's projected financials. Currently $5 million in revenue, losing $3 million a year. But it's expected to grow up revenue up to $40 million, be highly profitable, 34% operating margin, so very robust forecast. This is an overview of the company's cap structure, fairly simplistic, common, preferred, and an option pool. So we would run the guideline company analysis at the data value, so it syncs up with the subject company's data value. These are for example purposes only. They may be a little bit out of date, but you'll see the types of information that we look at out in the public market. We look at forecast revenue and trailing revenue levels, revenue growth rates, operating margins, and then again the valuation metric, enterprise value to forecast revenue, ranges from 1.5 to 6.1. That's 6.1. That may be an adjustment that looks a little bit like an outlier, so we may take that out. We'll be comparing, again, the guideline companies to New Design. So we've lined up New Design's metrics down here. Fairly robust revenue growth, and again, profitability up in the 34%, mid-30 range. So for the purposes of this analysis, we've chosen the median valuation multiple. 1.8, you'll see is the median from the selected comp set. So we'll take the company's projections to 2017 under the income approach, calculate its cash flows. We're using a discount rate, again, given the company's stage of about 38%. And then we'll come up with a terminal value based on the company's projected 2017 revenue and the multiple that we just selected from the guideline company. So you'll see this terminal value, once we discount it back to the data value, $17.9 million, ends up representing pretty much all of the value of the enterprise. To get to the market value of equity, we make adjustments for debt and cash. So under the income approach, we've got a value of $17.6 billion. So we'll try and corroborate that with another approach. I've selected the market approach, again, taking in the company's projected revenue out in 2013, applying the multiple, coming up with an enterprise value of $15.6 million, same adjustments for debt and cash, $17.1 million. So again, that's the value that's based off of the public company, so it would be considered a marketable value. So we'll make some adjustments along the way for that. So given where we are here, we've got the income market approach indications, 17.6, 17.1. They're fairly close, so we'll use an average of approximately 17.4 million. So now we know the value of the company's equity. We've got to slice it up amongst the various classes of stock to determine the value of the common stock. And Gunther Hofmann will walk you through that approach now.
Yeah, I'll say, if anybody's got questions, feel free to ask away.
So now that we know what the whole pie is worth, we want to know who's eating the pie and how much is each slice worth. The preferred, they eat first. That's why they're called the preferred shares. They have a number of meaningful and rights. Those are economic rights and control rights. The economic rights are readily and objectively measurable. The control rights, not so much. What's the value of board seat? Hard to determine, but all VCs want one. The economic rights, some of them can be mapped into allocation models, and I will run through some of those. There's three main allocation methods: the current value method, the option pricing method, and the probability-weighted expected return method, or short keyword. Most of the valuations for 49A purposes use the option pricing method, the OPM. I will spend most of my time on that. There's a couple of other possible allocation methods. They don't find that much use in the 49A market. The current value method, that is basically looking at the company, what is it worth today? If we sell it tomorrow, who gets what? Based on the liquidation preference, on any carve-outs, on participation rights. And it is really only used at a very early stage, or if there's a transaction imminent that we can calculate. This would be an example for the current value method. Companies worth 17.4 million minus 15 million liquidation preference gets us to 2.4 million divided by the fully diluted shares of stock, because it's participating preferred stock. So everybody gets a slice, 10 cents per common stock. Usually we take a marketability discount because the value was determined by comparison with public companies. And in this case, we're using 30%, gets us to 7 cents per common stock. The next allocation method is the option pricing method that treats the common stock and the preferred stock as call options on the enterprise value. That's a little complex, so we put that into a graph. This is the payout graph. Here on the x-axis is the total exit proceeds if the company is sold. And here on the y-axis is the payout, so who gets what out of those proceeds. And the blue line is the preferred stock payout, so up to the liquidation preference of 15 million, the preferred stock gets everything. And after 15 million, the preferred gets 40% of all additional proceeds because it's fully participating. And then the common stock only participates once the liquidation preference is reached. So in our example, it is 17.4 million. Preferred stock gets 15 million plus 40% of the 2.4. So they get a total of 16 million. Now if we carve up this more complex payout function into two separate functions. One is the right to receive proceeds from the sale of the company for less than 15 million. And that's really where the preferred get their preference. And the second is the right to receive proceeds from sale of the company for more than 15 million. And that's where the common participates. So for purposes of 49A, we're really interested in this right B, participation above 15 million. And that is just like the payout function of the call option. So with the strike price of 15 million, and the common stock participates above 15 million. So what we really want to do is, what is the value of this right B? And for the valuation of call options, there's established methods, like the Black-Scholes methods, lattice model simulation. And all we need is a couple of observable inputs. One is the strike price, that's the liquidation preference. The value of the underlying security, that's what Brooke just calculated, that's the 17.4 million. Term to maturity, that is understood as a time to liquidity, a weighted average time to liquidity, so it might take 8 years to an IPO. It might take 2 years until the company runs out of money, so we're using a weighted average. The volatility, we get that from guideline companies. And the risk-free rate, we get that from the Fed. And this is how such a model would look like. So we're interested in this right B, the right to receive proceeds above 15 million. Here are all our inputs, 17.4, 15 million liquidation preference, 3-year term, risk-free rate, gets us an option value of 8.5 million. So that specific right is worth 8.5 million. And we know the common stock gets 40% of that. We calculate that here, that's 3.4 million divided by just the common stock, 10 million shares, minus a marketability discount, gets us to 24 cents. And that's a simplified version of the option pricing method. Yes?
So even though the company worth is what, 17 million?
Yes.
So the common, if it were to sell today, gets to participate in about $2 million, right?
If we sell it tomorrow.
Okay, tomorrow.
But this assumes that the company is sold for the term of 3 years.
Right, okay.
Today it's worth 17.4 million, but in 2 years it could be worth 100 million, or it could be worth a cent.
And that's based on the volatility?
That's based on the volatility, yes. So it takes an approach that where everything is possible with a lot normal distribution.
It strikes me that this method also does not take into account the ability to convert to cash. In other words, it always assumes that there's a ready market for that stock once I exercise the option.
This assumes that after 3 years, as a weighted average, the company is sold and everybody gets liquidity.
In other words,
So that is a simplifying assumption.
There are a lot of problems with this
Yeah.
model. But the reason it's in such prevalent use is because the only people at the table are the accountants today. The IRS hasn't shown up, other than this one case hasn't weighed in on methodologies. They were a party, one of 25 parties in the creation of the guide that we talked about, the AICPA guide. But other than that, they've provided no guidance.
So then a subgroup of this option pricing method is the recent transaction method. And that changes the market value of equity until what's allocated to the preferred stock is what it was issued at. If we go back to our model, we see that we can calculate the preferred stock value here. Right now that's $1.23, but we know they paid $1.50. So the question is, how do we have to modify the market value of equity so that exactly $1.50 is allocated to the Series A, and then what's allocated to the common stock? We did that in this example. So at 22.7 million, exactly $1.50 is allocated to the preferred stock, and 36 cents is allocated to the common stock. And again, this is a simplified model. That's the recent transaction approach. And it's usually used if there's an arm's length transaction in the preferred in proximity to the valuation date. We have to apply it with caution, so if it's too long ago, it might not be relevant anymore. If it's an inside round, maybe investors want to protect their previous investment. It's not arm's length. If it's a strategic investment, or if there's other agreements, if there were warrants issued, for example. Also doesn't take into account control characteristics, like I said, how much is a board seat worth. Underlying probability distribution, that's when we dig deeper, is the future really log-normally distributed for a startup company. But it's very often seen in the valuation reports. The third large method is the probability weighted expected return method, the P1, and that calculates specific scenarios of future events that are possible and probable, and then calculates probabilities for each of these scenarios and who gets what in each of those scenarios, and then discounts everything back to today's dollars. It's usually used once there's a transaction on the horizon, so if there's some visibility into how a transaction would look like, into an IPO, the SEC would expect to see a P1 analysis when we already know where the company is going to come up. But it's based on management assumptions, the probabilities, so it's not as easily auditable than the option pricing method. Here's an example. We're using IPO, merger, liquidation, continuing operation scenarios with probability of occurrence and get a value for the common stock. Here's an overview of the values that we came out with. So it's really important to be cognizant about which method would be used in which case, and they can come out very differently depending on the circumstances. And this is an overview, pros and cons of these methods. Like I said, the option pricing method is probably used in 80–90% of these 1A valuations. It's a closed form model, so we have input on the one side and we get a deterministic output on the other side. It's complex to implement and probably even harder to communicate to the client. And the model assumptions, they're really buried within the model. Like I said, it's really a log normal distribution now. But it's readily auditable, so it's used in the majority of valuations. Current value method doesn't get much application, only really in the probability weighted expected return method, where we have a future scenario, probability weighted to today. Here we did a couple of calculations to see, well, what happens if our example company, they have a Series A, 15 million, now we go out and raise a Series B. And we want to know what's the influence of the different terms on the valuation for the common stock and for the enterprise. So we calculated a Series B 10 million at a 60 million post-money valuation, meaning they pay $2 per share. And we calculate how much is the Series B and all the other classes worth if we have a determination that the market value of equity is worth 45 million. And then we have a second set of calculations where we say, well, the value we keep constant at $2, but we modify the price of the Series B. So everything else must be worth something different. So this is the first set of calculations. Here in the second row we have the Series B. We issued pari passu, fully participating just like the Series A, 1x liquidation preference. And we made a determination that the company is worth 45 million. So how does that break down? In this case, the Series B would be $2.32, so they would have overpaid, and the common stock is worth 64 cents. Now we take away rights from the Series B. We make it less valuable. We make it non-participating compared to the Series A that's participating. It loses in value, $1.86, and that value gets allocated to the other classes of stock. And now we make it more valuable, so we add rights. To make it senior to the A, again at 45 million, it allocates $2.64. That value gets taken away from the Series A. The common stock, they don't really care because they eat last anyway. They eat after the Series A, after the Series B. And here we gave the 2x liquidation preference. So now they have liquidation preference of $4, makes them worth $3.78. And that value gets taken away from the A as well as the common stock. Now in this example, we have the market value of equity, the whole enterprise is worth 45 million. And then we vary the rights of the Series B. In the next example, we set the Series B at a value of $2. So they pay $2, the security is worth $2. So everything else needs to be worth something different if we add rights to the Series B. So here we take rights away, non-participating. Series B is still worth $2. Market value of equity must be worth more, and all the shares here are worth more. Now, if we add rights to the Series B, it becomes a more valuable security, and that value comes from the common stock and the Series A. So the 2x liquidation preference example, the common stock gets crammed down to 8 cents. Because in effect, the Series B is they pay $2, but it has a liquidation preference of $4. So it sucks away a lot of the value from the other classes.
So this methodology always has to be a zero-sum calculation. In other words, entity value is X. If one class of stock has Y value, then X minus Y has to be the other class of stock.
Yes. Yes, with the caveat.
That's how I look at it.
We do calculate here a marketability discount. So we have the 23 million in this case, and we allocate it to all the classes. But on a theoretical level, they're still on a marketable level. And then we take away value for the non-marketability of certain security types. And arguably, the marketability of the common stock is different than the marketability of a preferred stock.
But if you could determine what the weighted average discount for lack of marketability was between the classes and took that off the market value of the whole entity, then it would be zero-sum at the allocation level.
Well, you first bring up the whole value into the slices, and then you discount the individual slices, right?
So the short answer is yes, it adds up. So we have the common stock 3.4, the options 1.7, the Series A 12.3. So this line here adds up to 17.4.
But that's before DLI.
That's before DLI. There's no more questions on these examples, and I would hand it over to John.
So, a couple of takeaways, or a few takeaways, hopefully that you got out of here, is in our business, generally more valuation methodologies are better than fewer. The more, approaches that intersect, the better it is. As you heard from Gunther and Brooke, there's a lot of assumptions that go into this. There's a lot of judgment. There is no one right answer. There's probably a range of right answers. So the more, those different outcomes kind of fall within the same realm, the stronger the opinion might be perceived. On the allocation methods, which Gunther just talked about, generally we would only use one. The reality is, as we talked about, every valuation from somebody's perspective has a bias. Right? If it's 409A, the bias is low. If it's somebody given some shares to his university, the bias is high. So there's always some bias in valuation. There's a lot of judgment in valuation, and so when you apply different judgments and assumptions, there's some room to kind of work with the outcomes and still maintain our independence. We talked quite a bit about recent transaction. This really is very important these days because there probably 50% of our relatively more mature clients are experiencing secondary transactions. Either they're fundraising, so they're raising new preferreds, or worse, they've got employees, shareholders who are selling on active markets or selling to investors who can't acquire otherwise and are buying from them. So being able to, and often those values those transactions are being valued, it's substantially different than the 409A conclusion, and that's high. So, a lot of our clients come to us, they say, well, how are we going to deal with this? We don't want to blow, these people are free to sell, but on the other hand, we don't want to blow our 409A valuation. So it becomes a real test to determine what the factual elements of that transaction are from a tax standpoint, and determine whether it meets all the tests for fair market value, arm's length, et cetera, and try to come out with some resolution. Obviously, it becomes really difficult to deal with these things if there's a pattern of trading activity. You all probably remember Facebook before it went public. I mean, it was trading daily at $32, over the counter in the secondary market. So it'd be really, even though you didn't have the elements of the individual trades, it'd be really difficult to make the case that, in fact, the company's value wasn't $32, is a case in point. Discounts for lack of marketability. Every valuation privately held company needs to deal with this at some element or another. Brooke indicated, those numbers can be maybe as low as 10% for companies that are talking about filing a registration 3 months from now, or are actively out seeking an M&A partner, to 50% or more for companies that are coming out of the box. Literally out of the box today and have nothing. So, again, it's an assumption. There are quantitative models which we use and often demanded by the accountants' financial reporting world. But the reality is they're generally used to confirm judgments about where those discounts ought to be. What we didn't talk much about was discount for lack of control. If the primary method to establishing value is M&A, and you're using consequently a control level valuation metric, then we would need to take a minority discount to reflect that as we work back into private illiquid. Judgment on all of the inputs, many of these inputs is important, not only to arrive at a reasonable valuation, but because virtually all these opinions get challenged at one level or another, if not by the company, then by its auditors, and now, maybe eventually by the IRS. So documentation of all those assumptions is highly important. Okay. So I think we've done our part. Unless people have other questions, appreciate your patience. It's a little warm in here.
Okay, well, I want to thank you folks for stopping by and giving us this presentation. This webinar is going to be recorded and posted on YouTube as well as on Royse University. So thanks again.